Traditional retail relies on a specific set of mechanics: buy products at volume, apply the highest market the market can tolerate, and aggressively minimize operational costs. Here, Wall Street rewards companies that keep labor expenses low to protect those profit margins. Costco ignores those incentives. It operates as a massive global outlier that refuses to prioritize high product margins or cheap labor. By intentionally suppressing markups, the company runs a model that appears to invite financial ruin. Management enforces a strict 11% cap on product markups. Even as inflation climbed, they held their hot dog and soda combo at $1.50, a price unchanged since 1985. Co-founder Jim Sinegal applied that same logic to the workforce. He established average wages well over $20 an hour and ensured that 90% of employees received healthcare benefits. Analysts once called the company too benevolent to survive, arguing that such high costs would eventually break the business. Instead, Costco generated over $242 billion in 2023, making it the second largest retailer on the planet. This raises a question: how does a global powerhouse dominate a market while refusing to maximize profits on the products it sells? The warehouse floor is effectively a stage for a different business model. Costco generates its real profits before a customer ever picks up a product. Those 3,700 items on the pallets are sold near cost to ensure massive, recurring foot traffic. Membership fees represent only 1.9%. This makes the grocery operation a primary marketing engine for a high-margin subscription service. To maintain this system, Costco relies on a mechanic called the negative cash conversion cycle. While a standard supermarket manages over 30,000 different products, Costco limits its warehouse to just 3,700 high-volume items. This results in extreme inventory velocity. Items move so fast, the entire inventory turns over 12 times a year. Members provide cash long before the supplier's invoices do. This allows Costco to use member money to pay vendors, keeping cash reserves liquid. The 11% markup cap ensures the extreme inventory velocity needed to keep the entire engine running. High wages and healthcare benefits function as structural components of this warehouse engine. While the national retail turnover average is 67%, Costco maintains a 5% turnover rate for established employees. This retention eliminates the massive expenses of constant hiring, training, and lost inventory that plague other retailers. An experienced, stable workforce allows an individual warehouse to generate an average of $309 million in annual sales. High wages act as an investment in productivity, creating the operational leverage needed to sustain those low product margins. Decades of refusing to maximize product markups have earned Costco 82.9 million loyal households. That historical trust is now driving their digital expansion in 2026, leading to triple-digit growth in traffic from AI-powered search. The company's digital delivery times have dropped below 45 minutes, and their AI-driven recommendations are converting at 3 times the industry benchmark. Members rely on these AI recommendations because the company has spent 40 years proving it won't inflate margins for a quick profit. That belief removes the need for comparison shopping, allowing digital sales to scale with the same velocity as the warehouses. The company serves as a primary example of stakeholder theory, the idea that prioritizing employees, suppliers, and customers ultimately generates the most value for shareholders. Costco's growth over the last 4 decades provides the data to prove it. By treating culture as a business strategy rather than a perk, Costco created a model where the well-being of the employee and the value for the customer are the exact mechanisms that drive profit.